Hello again, accounting scholars. We are about to embark on one of the most exciting sections of this particular chapter. Section 6 is going to cover some of the most important costs that are used in decision making, and really, to be honest, are quite fun. But let's get started, because one of the things that we're talking about here are the variables that you're going to be using as a manager of a business or an owner of a business um, to determine various key operational numbers. For instance, what your break even point is at various revenue levels or production levels. And so the characteristics of the variables you use are very important because they need to be relevant. So, one of the things that you want to make sure of if you're using a variable in the decision making equations that you're using is, number one, that the variable must occur in the future. Um, if you're talking about a cost that's not going to occur in the future, in the period that you are talking about or evaluating, it's not relevant. Um, and the second thing that is very important is it must differ from other alternative variables. It essentially can't be the same thing. So those are the two characteristics of relevant variables. It must occur in the future, and it must differ from alternatives. Okay, so let's um, let's talk about the differences of various relevant variables that you would typically use in equations for um, decision making. So the first one is called sunk costs. This is a very common term in managerial accounting and managerial decision making. And simply put, um, sunk costs are past costs that are not related to current short-term decisions. Um, they're typically they're typically not relevant because they have occurred in the past, and they do not impact the future decisions that you are making. So that's the first difference among the variables. The second is what is called opportunity cost. Now, you may have heard this term before, some of you that have taken AP economics, and you may remember it from introduction to business. Opportunity cost has to do with choice. And as this cute little picture shows, uh, if I if I choose a lollipop with my money, uh, and that's all the money I have to spend, then I forego the opportunity to buy a chocolate bar, and vice versa. If I choose a chocolate with the money I have to spend, and that's all I have to spend, then I forego the opportunity of um, uh, the other item. So opportunity costs are, in more technical terms, are benefits that are foregone. Um, and typically, those are always relevant in short term decisions uh, because you're looking at alternatives that if you choose one in a given time frame, it may prevent you from choosing another. So that's now we've talked about sunk costs, we've talked about opportunity costs. Now let's talk about the third, which is incremental costs and revenues. And by the term incremental means just that. And it additional cost or an additional revenue that will occur as a result of decision. And this is typically relevant if the amount differs among the alternatives. So let's say you're evaluating the decision of manufacturing a laptop PC versus a desktop PC. You would look at the incremental costs and or revenues associated with manufacturing one type of a computer or another. There would be a difference among the alternatives. Okay, so now we're ready to move on to the next section, which takes into account the relevant areas with regard to unit, batch, product, and facility activities. Again, here is two categories that we talked about, and the first is that they must here again be relevant. And by this I mean depending on the situation, the unit-related costs, the batch-related costs, the product-sustaining costs need to be relevant. The second is what we talked about a little bit earlier, which are facility-sustaining costs that are typically fixed and generally not relevant to short-term decision making. In this particular example, let's say you're looking at Wrigley Field here. The cost of water, and in utilities to run the baseball stadium, those costs are fixed. It doesn't necessarily matter if they have two games. Those costs are fixed through a given period. Okay, what are the types of short-term decisions that you must make as a manager? The types of decisions here are typically called accept or approved decisions or reject decisions. So that is a question mark. For instance, a company must determine whether to sell a product to a customer at a reduced price. In order to make that decision, you want to determine what the incremental profit is if you choose that particular choice. And so that would be what would be considered an accept or reject or approve or reject decision. Those are the kinds of decisions that you would be using your managerial accounting analysis to determine. Another type of decision is what is called a make or buy decision. A company must determine whether to outsource a particular product or determine whether it should be made inside the company. So the company has to determine the relevant costs to make the decision to make or buy or outsource or keep in-house a particular product. So these are called make or buy decisions. And the last but not least decision that a customer or a company must make is what's called a keep or drop decision. No pun intended with this particular iPhone, but you in essence make this same decision sometimes with your cell phone, right? If you do have a cracked screen or cracked case, you may say, do I keep the iPhone or do I drop it and go with a Samsung? Similar kinds of things are done with companies as it relates to products or product lines. The company must determine whether to keep a seemingly unprofitable product or to drop it. And here again, an analysis can be done to determine the relevant profit or loss associated with a product line, with that product line question. All right, guys. So we are done with section 6. Have a great night, and here again, make sure you've got all these particular definitions well documented in your notes, so you're ready for the quizzes and future tests. Have a great evening. Bye bye.